Hello everyone, welcome again. In this video, I'm going to cover what is a good return on investment or ROI for real estate investors. What one investor considers a good ROI may be unacceptable to another. A good ROI on real estate varies by risk tolerance. The more risk you are willing to take, the higher ROI you might expect. Conversely, risk-averse investors may happily settle for lower ROIs in exchange for more certainty. In general, however, to make real estate investing worthwhile, many investors aim for returns that much or exceed the average returns on a major stock market index, such as the S&P 500. Historically, the average annual return on the S&P 500 is about 10%. Of course, you don't have to buy physical property to invest in real estate. Real estate investment trusts trade like stocks on an exchange, and they can provide diversification without the need to own the manage any property. In general, REIT returns are more volatile than physical property. They trade on an, an exchange after all. In the US, equity REITs delivered an average annual return of 10.7% for the 5 year period ending March 31st, 2022, as measured by the FTSE Nareit All Equity REITs Index. You can also invest in REITs through mutual funds that specialize in them. So here is a warning here. Mortgage lending discrimination is illegal. So we have covered this warning in the previous videos, so we skip it. Costs that can reduce your return on investment, ROI. In order to realize your ROI in actual cash profits, you have to sell the property. Often, a property will not sell at its market value, which will reduce your expected ROI if that was the number you based your calculations on. In addition, there are costs associated with selling real estate, such as repairs, painting, and landscaping. The cost of advertising the property should also be added in, along with appraisal costs and the commission to any real estate agent or broker that's involved. And of course, if there is a mortgage on the property, it must be paid off. How is investment real estate taxed when you sell the property? When you sell investment property, any profit you make over your adjusted cost basis is considered a capital gain for tax purposes. If you held the property for a year or more, it will be taxed at capital gains rates. If you held it for less than a year, it will be taxed as ordinary income, which will generally mean a higher tax rate, depending on how much other income you have. And then we have how is income from a real estate investment trust, REIT, taxed. Real estate investment trusts, or REITs, can pay income to their investors in three forms: dividends, which are taxable at the same rate as ordinary income; capital gains distributions, which are taxed at the usually lower rate for capital gains; and returns of capital, which are not taxable. So, how is rental income taxed? If you have rental income from a property you own, you have to report that income when you file your taxes for the year, generally on IRS Schedule E. You can also subtract your uh, related expenses to arrive at your total income or loss on that property for the year. Losses are deductible up to certain limits. So the bottom line of this article is calculating your ROI as a way to determine how much profit, if any, you have made on a real estate investment. You can also use it to compare the return on real estate to other potential investments, such as stocks. The examples above are simplified for the purposes of illustration, and depending on all of the costs involved and any potential cash flow you receive from your real estate investment. Getting a precise ROI may be more complicated. For tax purposes in particular, you will almost likely want to consult an accountant or other tax professional who is familiar with the rules as they apply to real estate. Thanks for watching this video.